Hello, I am Kim Grothwell, Vice President of Strategic Markets with Oak Street Funding. Today I am here with Chris Hughes, Managing Director of M&A Services. Hi, Chris.
Hey, how are you doing, Kim?
Good, good. Today we'll be discussing valuations, deal structures, and key takeaways to a successful 2024 in M&A. Chris?
Thanks, Kim. Thanks for having me today. As Kim mentioned, my name is Chris Hughes. I'm with M&A Services. I'm the Managing Director, and I head up our insurance distribution practice. And by insurance distribution, I mean any kind of firm that handles the sale of the insurance product. That could be a retail agency, wholesale agencies, MGAs or MGUs, management companies of risk retention groups, or management companies of captives. Any type of company that sells the insurance product, those are the types of companies that we work with. Today, we're going to talk about how to value insurance distribution firms. And by distribution firms, I mean both P&C as well as employee benefits firms. Not so much on the life side, that's a different animal. Most of our focus is on P&C and employee benefit firms. The basic methodology to value any insurance distribution firm is a multiple of pro forma EBITDA. So I'm going to jump right in and just talk to you a little bit about what EBITDA is, what pro forma EBITDA is, give a couple of examples that we're going to use throughout our discussion here. EBITDA is earnings before interest, taxes, depreciation, and amortization. So you would take your income statement and you would adjust out all of those non-operating EBITDA definitional items. So interest income, interest expense, you take those out. Federal and state income taxes you take out. You would leave in items such as payroll tax, but for purposes of EBITDA, you take out income taxes, state and federal. Depreciation and amortization, you take those out as those are non-operating items that run through your income statement and balance sheet. And then you do a pro forma analysis. So you would line up on the left-hand side your actual income statement for any insurance distribution firm. And then you would make some common adjustments. The biggest adjustment that we see in almost every agency is adjusting a owner-operator's compensation to what the market value is. So in privately held businesses, a lot of owners either take zero compensation or they take excess compensation. And what you want to do is you want to adjust that to what is a market compensation for that role and responsibility. And this is just to normalize all of the earnings and make it less of a personal enterprise and more of a market enterprise. So you make these adjustments. So you take out interest income, interest expense. You adjust for an owner's salary. If you have any non-core income or one-time non-recurring income or expense items, extraordinary items that only happened in the prior year and they're not, really necessary or ordinary to run the business. In the example here, we have $25,000. This is a P&C agency, and it had a one-time life insurance commission that the owner had bought for his wife. Also, the wife is on the payroll in this example, and she had a non-operating role, but she was on there for tax purposes and benefits purposes. So you would adjust that out. And then any kind of payroll taxes or benefits that you made to the compensation expense, you would make an adjustment for that line item as well. Non-recurring extraordinary expenses that you see are auto expenses that are run for the owner operator. You might have one-time non-recurring IT expenses. So if you move your agency management system from one system to Applied Epic, and you have a consultant come in there and help you migrate that over, that would be a one-time non-recurring expense. So you make all of those adjustments to your expense category, and there's a middle line to make those adjustments. And then you add those two up, and that's where you come up with your pro forma revenue and your pro forma EBITDA. And those two items are the basic starting point of valuing any insurance distribution firm. So in this example, we started with $6 million in revenue. We make the adjustments, and we end up at $5.9 million in pro forma revenue. We start with $1.6 million in EBITDA. We make all of the different adjustments that we just discussed, and you get to 2.045 million in pro forma EBITDA. That 2.045 million
So,
is the base metric of valuing an insurance agency. Yes, Kim?
so Chris, this is really good information, and you touched on something where it's the key starting point of the math behind all of it. At what point should a seller who is looking to sell, or even a buyer who is becoming a little more strategic in his acquisitions and really having more of a acquisition plan for his future, at what point should they start um, preparing their own company for either a sale or to be an acquirer? Because as an acquirer, you still have to have that business mentality and that methodology behind the way you're running your business, just as well as a seller. So again, at what point does it become really important to start managing your business just a little bit differently to be more of that mindset?
Sure. So, in general, I would say earlier is always better. It is great to have
Mm.
a full 1 year, if not a full 3 years of clean financials. It just adds credibility to your financials. So, if you're making all of these adjustments and you're running your business more like a personal expense account than you are a market business, you're going to have to convince bankers and lenders,
Mhm.
attorneys, and other parties, whether it's the seller or the buyer, that all of your financials and all these adjustments are actually good adjustments to take. If you run it very clean for 1, 2, or 3 years, it's almost like having audited financials where, hey, here's my income statement. There are no adjustments. This is what it is. It just adds a lot of credibility. So the longer that credibility period is, the better it is. That's not to say that these
Yeah.
adjustments aren't taken in stride, and especially if you have a third-party lender such as Oak Street or an M&A advisor or a good accountant really digging in, that all these adjustments might not be credible, but if you don't have to
Mhm.
make them, that just adds credibility to your financials, Kim.
Oh, absolutely. And again, you touched on that as well. As a lender, that credibility and the validation that this has been happening goes a long way when a buyer is using debt as well to acquire. So that those are really good things that we look for in the history of a well run performance of an agency or
Sure,
distribution channel.
sure. And really, depending on the size and the scale of the operation, it's almost advisable to have an audit as well prior to market or prior to trying to take out a large credit facility for a loan. Having audited financials brings a great deal of credibility and helps with terms and conditions all around the financing of the transaction. So once we get
Absolutely.
to that pro forma EBITDA of $2 million, then you apply a multiple to that, and the multiple varies depending on the size and the scale of the operation. So if you're less than $2 million in EBITDA, the multiple is generally in the 8 to 10 times range. If you get to that $2 to $5 million scale, you'll attract more buyers and the multiples go up to about 10 to 12 and a half times. And then once you get to 5 million and above, you become a platform to a lot of different types of buyers, whether they're strategic buyers or pure play private equity groups over $5 million of EBITDA. Really attracts a lot. And you would garner a valuation of anywhere from 12 and a half to 14 and a half times EBITDA. I think for privately held companies, the top of the market is about 15 times. So Aon just announced 3 weeks ago that they bought NFP, and they valued that at a 15 times multiple of EBITDA in a $13.4 billion transaction. So I think that's at the very top of the market. So that's the highest that we're going to see right now in today's current market. But I think these multiples have been very steady and kind of plateaued over the past, say, 18 months.
Now, Chris, do these multiples apply to the different distribution channels within the insurance, whether it be a retail or a specialty or an MGA? Do different does different mythology come into play here?
So, not a different methodology. The same multiple of EBITDA would apply. And I think that these ranges that I gave, that you can see on your screen, those would apply to whether you're a retail agency or a wholesale agency or an MGA. So, just a couple of examples. So, if you're a Texas non-standard retail insurance agency that does, I don't know, 10 million in revenue and $2.5 million in EBITDA, I think that 10 to 12 times, 12 and a half times EBITDA range would still hold true, but the market participants, the buyers, would be different for that agency than, say, if you're a New York commercial lines middle market brokerage firm. The buyers for that firm are going to be a little bit different, but if you're still in that $2.5 to $5 million range of EBITDA, the 10 to 12 and a half times multiple would stay the same. So I think the type of firm doesn't really matter as long as it's an insurance distribution firm, and the credibility of the financials, like we just talked about before, matter a whole lot. So if you have credible financials and everything sticks up, those multiples hold across different types of firms.
I say, in talking about that, there must be some, in terms of the overall valuation, other aspects that go into valuing an agency other than just the numbers. I mean, certainly there's alignment. There's key things why one agency or one firm is valued one way and one way it's not valued. So how do you put value on things like alignment, like leadership, personnel, just things like that? How does that work?
Sure. So we have a slide here that shows some of the key performance metrics that everyone's interested in, whether you're a lender, you're an attorney, whether you're a buyer or a seller. I'm just going to touch on a couple of them. So growth is a very big component of what makes a firm more valuable or less valuable. So and there's organic growth and there's acquisition growth. And even within organic growth, you have rate. So we're in a hard market in general in the P&C market. We're in a hard market where there's, if you don't lose or gain any clients, you're still going to grow at anywhere from 5 to 8% just on rate alone. And then there's adding new clients, and that's, I would say, the gold standard of organic growth is adding new clients and growing at say 5 to 10% on new client count growth versus just pure rate growth. So that's one big key component that makes a firm more valuable or less valuable. There's different kinds of concentration risks. So there's client concentration risk. Any client that makes up anywhere from 5 to 20 or more percent of the total revenue base, that can be a risk that would make a firm more valuable or less valuable. You have carrier contract risk. This is specific to, say, an MGA that might have one proprietary product with one carrier. That carrier contract is a big deal, right? Without that carrier contract, you might not have much of a business at all. So then that bleeds into how strong is that carrier contract? How long has it been in existence? How is that carrier doing? What's the loss ratio of this book of business with that carrier, right? So all of those, so each individual deal has different aspects that might make it more risky or less risky, more valuable or less valuable. Another thing is the key management and the bench strength of the management and producers, as well as the contracts, the non-competes and non-solicits that may be in place, or even the compensation structures. As we're seeing non-competes a little bit more under fire. I mean, California, they barely exist at all. They're not really enforceable, and that's becoming more of a nationwide trend. You see more of the compensation structure of the producers being the thing that ties them to the agency, not more punitive non-compete, non-solicit agreements.
That's certainly true for us as well as the lender, looking at when we're doing due diligence on a potential acquisition, and you're trying to first and foremost protect our collateral and look at our client and protect what they're buying. That's one of the key things that we're looking at is the strength and the runway of that leadership, and how strong that that leadership is, and also how the key employees, the risk of them leaving. And because that's a key part of that really critical transition period in an acquisition, where after the first year we can't lose that we want to continue that momentum and that growth. So those two things, the organic and the growth through acquisitions, is another thing where you see organic growth is something that can be sustained. And if it's got a track record, it certainly could have a track record to happen in the future. where growth through acquisitions is more transactional, where it happened and then it happens and then it doesn't happen. So absolutely, seeing organic growth is something that is very important to the overall value, and it gives this kind of a leg up if you have really strong organic growth.
Yeah. So, Kevin and Oak Street, when you come in and you look at a transaction, or you're looking at putting together a credit facility, what are some of the diligence things that go into that other than just a pure financial? Do you have a diligence team that comes in and acts as like almost a whole second set of eyes for the buyer?
Absolutely. We start from the very beginning looking at, internally, we're looking at all financials from both the buyer and the seller, determining and understanding their alignment. We spend a lot of time with our potential buyers. We get to know them. It's very important that not only does our business models align, it's also we want to make sure we're aligning with the people behind it as well, because it's a long-term relationship with these folks, and we just want to make sure everything is good. When we're on site, we typically do on-site due diligence where we meet. We meet in person. We get to we understand their operation, their culture, what's happening in their office or outside of their office. If a lot of these people are remote, so we meet in a remote location, but it is kind of taking it a step further beyond what's on the paper, because at the end of the day, the financials tell a great historical overview, historical performance, but it's meeting in person and understanding the future is what's going to be actually servicing the debt, is the future performance of the transaction. So that due diligence and meeting our borrowers in person is critical.
Sure, sure. So, and talking about doing due diligence and structuring a deal, there's a number of different components that go into a transaction. I'm going to talk about a few of those now that either maximize value for a seller and also minimize risk for a buyer. And some of the, number of these components can be in each different deal. And then I'm going to go through just a couple of examples of offers that are, current market offers out there in the marketplace. So one, you have cash and equivalents, and when we're talking about equivalents, that would be like AJ Gallagher or Brown & Brown are publicly traded companies. And if they issue stock as part of their transaction that's entirely liquid, that would be an equivalent to cash. So that is the most risky to the buyer, right? Because once it leaves one bank, the buyer's bank account goes to the seller's bank account, that's gone. And it's the least risky from a selling standpoint. The second component that we see in most offers are there's some kind of buyer equity or the seller retaining some portion of a minority interest in their selling entity. Third, in almost every deal, there's some kind of earnout component. Now, earnouts in the past, prior to maybe 3 or 4 years ago, were earnouts. Hey, this is what you have to do over the next 1, 2, or 3 years to achieve your base purchase price. The last 3 years, and especially in the last 3 years, all earnouts have been growth earnouts. So you get your base valuation in cash or equity at closing, and then any earnout is a growth earnout. Most of them have small 2, 3, 5% growth hurdle rates, but this is extra cash to maximize seller value in the marketplace. It's really been an incredible marketplace for the last few years. You may have lender financing or seller financing. Again, that aligns interests. So I think between the buyer's equity and having some kind of financing involved, that just gives I don't know. It's a little bit of a risk mitigation factor for buyers, and it gives everyone a second set of eyes on the financing that aligns everyone's interest in a deal. So, Kim, what kind of components do you see in your financing of a transaction?
We again want to definitely see alignment between a buyer and a seller. It's key in the way we lend. It's we the longer a buyer can stick around, or, I'm sorry, a seller can be in the picture, there is the sense of alignment where that the collateral, which is the revenue stream of the business, is not going to be stripped away or in jeopardy of being stripped away. And so we typically see a form of a seller note, whether it be a true term seller note or coupled with an earnout component as well. And as you pointed out, the earnouts are typically 1 to no longer than 3 years. And the performance metrics to those earnouts is really a good thing. I mean, it's not only good for the buyer, but it's good for the seller as well. It's a nice way to keep the legacy alive for him as well. Another thing we look at, we have seen more recently, more sellers rolling equity, and that is, and it's not we've seen where it's not the 2 to 5%. This could be a substantial, especially if that seller is staying on in a key management or leadership position. And that really is a lot. There's a lot of strength to that, and from a lending perspective, because you've got now really two owners coming together and both having a lot of skin in the game, and then they're backstopping that with even with the earnout, and then with debt as well. So you've got a really nice stack there that mitigates a lot of risk and spreads it where everyone's evenly taken the reins. But really, those are the things we're seeing, and I'm actually looking forward to, as we get into 2024, as M&A starts picking up, as a lot of these 2021 earnouts are coming due, how that is going to play together with both those acquirers who acquire a lot, are needing capital, or you figuring out how they're going to fund their acquisitions in 2024, along with earnout payments coming due in 2024 as well, knowing that what they did in 2021 is performing, which is great.
Yeah, so I think if we said anything in the peak of the market, I think happened in the mid 2022 range, and then inflation spiked in the third and fourth quarter of 2022, and interest rates followed pretty quickly thereafter as they ramped it up. So I think myself and a lot of M&A professionals and banks were like, well, wow, where's inflation and interest rates going to go in 2023? Where's valuations going to go? And candidly, I thought valuations would dip last year, and in fact, they didn't dip. What we saw was, as some of the more highly leveraged firms, such as PCF, kind of took a pause for a couple of quarters in their acquisition activity and in their valuation aggressiveness, you had others that weren't quite as highly leveraged or publicly traded step in. So AJ Gallagher, just being a firm that really stepped in and did quite a few acquisitions last year, whereas PCF did fewer acquisitions in 23 than they did in 22. You just saw the mix of buyers in the marketplace shift a little bit, but valuation stayed in the same kind of plateau level. As we end 23 and as we walk into 2024, I think what we have a little bit more is some stability in the marketplace. We are in a higher interest rate environment than we have been for the past 10 years, right? The markets digested the higher interest rate environment. And I think for the 2024, everyone's expecting rates to remain the same, or maybe in the second half of the year, even drop a little bit and soften a little bit, which could theoretically increase valuations a little bit, or at least increase the activity of acquisition as we go forward into the 2024 year. But I think there is a little bit more stability in the marketplace. I think that you'll see that the earnouts that are coming due, people know that they're coming due, and they know what interest rate environment that they're going to be in. So there'll be a little more stability in planning and financing in 24 and 25 than I think we saw in 23. There was a lot more uncertainty last year with the rate environment than there is going forward today.
Oh, absolutely. Yes, I'm hoping that I'm the same, and I'm seeing the same, thinking the same as well.
So I want to talk a little bit about a couple of different deal structures in the place. And to your point of having sellers roll equity, I'm going to show you a comparison of two offers. And offer A is an offer that both of these are using our example before, 5.9 million in pro forma revenue and 2.045 million in pro forma EBITDA. And we have offer A, which does 75, and they're both valued at a 12 times multiple of EBITDA. Offer A is 75% cash at closing and 25% of rolled equity into the buyer's equity. And then with an earnout, a 3-year earnout that pays 5 times any growth in EBITDA over a 3% hurdle rate every year for year 1, for year 2, and year 3. In this example, we have a 5% annual growth rate running for 3 years just to show how this stacks up. So you'd have 18 million in cash at closing. You would have 25% of the deal, or $6 million in the buyer's equity. And then you would have a 3-year earnout that, if you grew at 5%, would pay about $645,000 over that 3-year period. Offers like this are with, I would say, middle market type firms. They're about $1 billion plus or minus in value. This would be your World Insurance, the Hill Group, Risk Strategies, High Street Insurance Partners. All of them like to inject or offer equity into their transactions to align everyone's interests. In general, they have grown the buyer's equity by about a 25% or better compounded annual growth rate. So in this example, we would grow that over 3 years at a 25%. And you can see what the total value of the deal is if the stock doesn't grow versus if it does grow. Again, that $6 million in buyer's equity, there is risk reward to it. I mean, you are taking a privately held stock that is generally illiquid and could go, as much as it could increase in value, and historically they could decrease in value as well. Another kind of offer that you would get is more of a just cash-centric offer. These would be your larger firms, your AJ Gallagher's, your Brown & Brown's, your Hubs, your Assured Partners, multi-billion dollar firms. And in this example, again, using a 12 times multiple, they paid 95% cash at closing. And then they look at your forward 2 years of EBITDA, average those, and at the end of 2 years, they put that 12 times multiple at the end of 2 years on whatever that average is. So it can be a much larger earnout, coming faster. So it comes at the end of 2 years, and you get most of your cash at closing. So these are two offers that are, out there in the marketplace. There can be offers that have a 1-year true up provision to them. They can be, 100% cash at closing, then have a 1 or 2 year growth earnout based on a hurdle rate, or they can be just like this, where it's more, this is less risky for a seller. Offer B is less risky for a seller, but with less upside opportunity with the rolled equity. But these are the types of offers that, if you're a buyer, this would be offers that you're competing with. And if you're a seller, these are types of offers that you would be looking at and comparing when choosing a buyer. The next thing we're going to talk a little bit about is acquiring with debt. And we put together a slide here showing that same offer B structure. You're paying 95% cash at closing. So if you're a buyer, we're going to use a 10% interest rate. We're going to have some buyer synergies. And Kim, I'd like to ask you a little bit about this. So oftentimes buyers will put together their own pro forma income statement. And this isn't for the base valuation of a seller agency. This is for what does this agency look like if I acquire it? And for example, if I have a Travelers insurance contract that pays 12% new, 10% renewal commission with a 1% guaranteed override versus a much smaller agency that might have a Travelers contract with a 10% new, 8% renewal rate, a lower commission rate, and no override whatsoever. If that moves on to my book of business, I'm going to get an enhanced, revenue synergy once I combine those agencies together. So in these examples, I put together, a couple of the EBITDA synergies for either revenue synergies, or oftentimes the selling agency might have 1 or 2 accounting resources, but once they become part of a large organization, those resources become redundant. So there are real synergies from a buyer standpoint. And I'm sure that as you look to put together financing components to this, you look at the buyer's finances as well and what the combined resources look like.
Oh, absolutely. And I would have to say, at the end of the day, the buyer's resources are critical. because again, that is who is that's our borrower. So we look very, very heavily on that. But keep in mind that we do want to make sure that the acquisition has the ability, the target, the seller, that that has performed, that it performs well. It can almost stand on its own in terms of some debt. But understanding the multiples today, some cases it's pretty close. But again, you've got all the buyers' performance in the buyer's business. It comes to the table as well. So really, it's an enterprise. It's a global snapshot of what it looks like, and the weight of both together. But again, the lens is on both. Making sure. I mean, we certainly want to make sure a buyer's not getting into something that and too over levered, where the even though in many cases we've seen where the alignment is there's a very good reason, but wow, but we've seen ways to bridge those gaps. But to your point, we do look heavily on the buyer's financials, the buyer's performance, historical, and certainly going forward. You touched on a couple key things there on the um, pro formas of not only a seller, but as it carries over onto the buyer's balance, the buyer's financials, or absolutely where you're seeing where a buyer sees markets where, wow, if I had that, I'm going to go to a whole different level. Or maybe a seller has a market that they've always wanted and have and don't have, which is just as important. So certainly those things are top of mind when we're looking and doing diligence on on an acquisition.
Yeah, yeah. There's a lot of regional carriers right now that are very attractive. Cincinnati, Utica Mutual, think carriers like that a lot of buyers and sellers see as a very big add to an acquisition. Also, there's an accretive value from a buyer standpoint. Again, going back to that prior slide, the larger you get, the larger your multiple is. So for a larger buyer that might have a multiple of 13 and a half times, and they're buying a selling agency at 12 times, there's an accretive value, 1.5 times EBITDA. Immediately, as soon as the acquisition happens, that EBITDA of the seller becomes the EBITDA of the buyer, and it becomes much more valuable or accretive to the buyer. So, using two examples here, we have a transaction that's 100% cash financed, and we run that out over 3 years, even using the same EBITDA synergies, same tax rate, same market arbitrage of using a 13 and a half times multiple. And you can see after 3 years, if you use all cash, you've got an internal rate of return of 19% and a 3-year cash on cash return of 1.7 times. If you use $2 of debt for every dollar of equity that you put into it, so you put 7.7 million of your money into it, $15 million of debt on it, definitely cash flows from a debt perspective, but the internal rate of return at the end of those 3 years is 64%, and your cash on cash return of your initial investment of $7.7 million is 3 times. So this is really how the private equity model is built. And this is why you see private equity firms trading every 3 to 5 years, is they're looking for that 3 times cash on cash return. And almost everyone uses debt. We're using a 10% interest rate in this example, and it's still, even at that high rate, throws off a 3 times cash on cash return at the end of 3 years. So if we enter into a little bit of a lower interest rate environment, that could even happen quicker, or the returns could even be that much higher. But this chart really demonstrates the value of using debt in a transaction.
Yes, thank you, Chris. You just made my sale. So you're absolutely right. It's the debt is cheaper than equity. It's always been the case, and even in the interest rate environment we've been in over the last 18 months to 2 years or 18 months, um, it's still if the acquisition is, as you pointed out, accretive going in, and you're coupling it with the right way, with a structure that levels out everything, and adding debt, you really can walk away with, again, even at a 10 or 11% interest rate, you are making money. It's a really good strategic way to do it, and doing it the right way and knowing going into it. And that kind of really circles back to a really key thing is successful M&A in 2024, to remember those things, that, let's doing things maybe a little bit differently, stacking things a little bit differently, finding better ways to make sure at the end of the day, when these acquisitions, when you're looking at them and when they're happening, doing where you're walking away out the gate with an accretive situation.
I think almost all M&A transactions are successful. I'd say the biggest risk that we see in any M&A transaction is just the moral hazard of, if it's an all cash transaction and you were expecting the owner operators to stay involved and grow it, and really they were just looking to retire. That's almost the only situation where I've seen that the transactions haven't worked out. So I think for this 2024 year, I think we're going to have an increase in financing activity, and whether that's refinancing or recapitalizing some of the purchases that were made 2 to 3 years ago, or just as the interest rates decrease, I think a lot that's going to free up a lot more capital and increase our acquisition activity in 24 versus we had a relatively subdued 23. I mean, number of transactions was a little bit more in line with pre-COVID years than the gangbuster year of 21, 22. But I think in 24, we're going to see an increase in activity, and whether that's an increase in financing recapitalizations or just mainline acquisitions, I think we're going to have a great year for M&A this year.
I think so too. I really do. So, Chris, well, I believe our time is getting close to winding up. Thank you so much for spending the time with us this afternoon, talking about M&A and M&A in 2024, and in terms of the just key takeaways, things to really keep top of mind when we're entering into 2024. What would you say would be the 3 things just to keep top of mind?
I think top of mind, one, valuations are going to remain elevated. 2, to keep interest rates going forward, and just following the Fed and the election in mind, top of mind, right? I think we're going to be in a more favorable environment than a less favorable environment from a lending standpoint. And 3, I think just adding the different deal components and keeping top of mind that there's different ways to structure a deal between cash, equity, financing, earnouts. I mean, those are all components that give everyone a lot of flexibility in doing a deal. So I think 1, valuations; 2, financing a transaction; and 3, using all of the available tools in your toolbox to get to the finish line. Those would be the 3 things that I would keep top of mind. Well, thank you so much for having me on the show, and I appreciate it, Kim. Nice talking with you.
Well, I appreciate it as well. Thank you, Chris.